The stock market is officially closed for the session on this June 23, 2026, but looking back at yesterday's close on June 22, 2026 at 4 p.m. Eastern Time, BigBear.ai Holdings under ticker BBAI wrapped up the day at $3.83 per share, marking a decline of 2.3% as it dropped 9 cents throughout the trading hours. While mainstream sentiment often groups small-cap enterprise software providers together as mere speculative bets waiting for a macro lift, something far more calculated is happening behind the scenes. Sophisticated market participants are quietly tracking a major divergence between standard public data and institutional order flows, which reveals that despite the surface-level downward pressure on the stock price, actual whale wallets and major intelligence contractors are building structural positions that completely contradict retail behavior. When everyday retail buyers look at a small-cap option like BigBear.ai, the expectation is that it should effortlessly ride the coattails of giants like Nvidia stock, mirroring the parabolic trajectory seen across major tech indices. The common ground among casual market watchers is that any business with an intelligence label attached to its corporate name should experience massive compounding valuation expansions during periods of sector-wide capital injection. However, the stark reality is that enterprise deployment for federal defense applications requires vastly different procurement timelines and validation protocols than consumer-focused platforms. This structural friction creates a massive psychological trap for short-term traders who expect immediate cash generation, forcing them to liquidate their holdings in frustration while institutional buyers quietly sweep up shares during quiet consolidation phases. To fully dissect what is moving BigBear.ai right now, we have to examine the immediate microstructure of its daily trading swings and structural liquidity. Over the last month, trading volumes have regularly spiked past 30 million shares, a clear sign that heavy hands are matching retail sell orders without triggering massive upward slippage. In the options market, unusual call activity has been building in far-out expiration dates, which indicates that sophisticated block traders are setting up long-term protection grids rather than chasing brief momentum pumps. When you look at platforms offering self-investing capabilities or simple individual brokerage setups, retail investors are largely treating this name as a lottery ticket, frequently executing emotional stop losses. Meanwhile, automated institutional algorithms are systematically scanning the order book to accumulate blocks without disrupting the daily volume-weighted average price. This friction between expectation and reality is exactly why modern platforms like Schwab Intelligent Portfolios and other automated intelligent portfolio tools handle allocation with strict risk boundaries. When a retail trader tries to timing a small-cap technology play without institutional tools, they often find themselves trapped in sudden intraday downward spirals. If you manage your capital via online investing or search for automated investment help across various top investing sites, the golden rule is understanding that high-volatility software names behave vastly differently than blue-chip anchors like an Apple stock or a Tesla stock. Retail participants who rely purely on social media momentum often fail to monitor the true underlying liquidity shifts that govern how small caps absorb macroeconomic shocks, particularly when the broader indices are experiencing quiet sector rotations. For anyone running an active strategy through an individual brokerage account, the software sector is currently dealing with intense margin pressure from rising technical operational overhead. On platforms like Robinhood, where Robinhood stock trading and intuitive Robinhood app interfaces have made retail options highly accessible, retail interest tends to follow raw price action rather than back-end federal backlog adjustments. Those executing Robinhood investments or utilizing Robinhood crypto or Robinhood cash management services to balance their active cash balances often view smaller data analytics firms as pure trading vehicles. However, when we analyze the actual execution data coming through institutional desks, a different pattern emerges where long-term funds use tools like Robinhood fractional shares to slowly accumulate positions over weeks, building a solid floor beneath the asset. At the same time, the broader retail ecosystem on SoFi Invest shows a growing sophistication as users leverage advanced features like SoFi investing tools to track equity trends. Investors buying into SoFi stocks or allocating capital across diversified choices like SoFi ETFs and automated systems like the SoFi Robo-Advisor understand that tech speculation requires a clear distinction between active trading and passive holding. Within the framework of SoFi active investing on the primary SoFi trading platform, the main tension for BigBear.ai is its reliance on large-scale lumpy federal revenues rather than predictable subscription cash streams. This lumpy revenue architecture creates massive volatility spikes on earnings days, causing massive shakeouts that test the conviction of even the most experienced self-directed account holders. For more precise execution and detailed visibility into global clearing data, looking at the order flow on Interactive Brokers provides an even clearer view of the professional landscape. The deep analytics provided via Interactive Brokers trading setups show that institutional block orders are executing at critical technical support levels, ignoring the emotional noise found on retail forums. Traders utilizing the comprehensive Interactive Brokers platform benefit from lower structural friction, making Interactive Brokers fees highly efficient for handling large, multi-legged option strategies. When you open an Interactive Brokers account to run systematic algorithmic stock trading, they look directly at clearing volume and the net delta of outstanding option contracts, both of which suggest that BigBear.ai is experiencing institutional accumulation masked by retail capitulation. Let's step back and look at what BigBear.ai actually does as a business enterprise to understand why this institutional accumulation is happening. The company specializes in providing predictive analytics, decision support software, and complex data parsing systems primarily for the United States Department of Defense, the intelligence community, and global supply chain logistics hubs. Their business model relies on deploying complex algorithms to ingest massive, messy datasets from completely disconnected sources, turning that raw information into actionable operational directives for field commanders and logistics managers. While a massive corporation might build broad consumer applications, BigBear.ai focuses heavily on high-stakes, highly classified environments where data accuracy is a matter of national security, creating a structural moat that commercial software startups simply cannot replicate. Historically, the company entered the public markets via a blank check merger, a structural route that left it exposed to the aggressive post-SPAC liquidations that hit the entire small-cap universe over the past few years. Past financial reports have consistently highlighted negative net income figures and substantial stock-based compensation overhead, which served as a major warning sign for traditional fundamental screeners. However, looking closely at their recent first-quarter financial statement for this year, their total defense backlog increased significantly, anchored by over $60 million in fresh national security contracts. They also affirmed their full-year revenue guidance while showing an improved cash runway of over $100 million on the balance sheet, proving that their financial core is slowly stabilizing even as short-term net profit margins remain negative due to historical debt servicing costs. When you look at standard brokerage ecosystems like Fidelity, the way long-term wealth managers approach this asset class is through strict, diversified thematic baskets. Investors researching Fidelity investments or examining specific Fidelity ETFs and broad market Fidelity mutual funds typically look for consistent cash-flowing enterprises within a standard Fidelity brokerage framework. For those managing long-term retirement capital through Fidelity wealth management tools or personal Fidelity IRAs, a high-beta small cap like BigBear.ai rarely appears as a core holding. Yet the tech-savvy segment of their user base utilizing the Fidelity mobile app and the professional Fidelity trading platform is increasingly tracking the company's recent torsional expansion, such as their newly announced supply chain asset deployment in Panama's Dry Canal Zone, which signals a deliberate effort to diversify from pure government reliance. Please take a moment to engage with the channel and share your perspective on this structural trend. Comment below how many shares of BigBear.ai you currently hold in your portfolio, and let me know if you believe federal defense contractors will continue to outperform the broader commercial software market throughout the rest of this year. Looking forward at the potential future scenarios, the investment case for BigBear.ai remains tied directly to the battle between near-term fiscal reality and long-term narrative expectations. On one hand, the optimistic scenario relies on the rapid conversion of their substantial contract backlog into recognized high-margin software-as-a-service revenues. If they can successfully transition their customized government modules into scalable commercial supply chain solutions, their gross margins will expand dramatically, forcing a complete re-rating of the stock toward commercial tech multiples. Furthermore, the accelerating global demand for counter-drone security systems and edge computing asset tracking provides a structural tailwind that could trigger a massive influx of institutional capital. Conversely, the pessimistic scenario cannot be ignored by anyone focused on defensive capital preservation. The primary risk stems from the prolonged sales cycles inherent to federal procurement, where government budget delays or shifted legislative priorities can instantly freeze expected revenue streams for quarters at a time. Additionally, because the company operates in a highly capital-intensive space requiring top-tier engineering talent, their research and development expenses could continue to outpace revenue growth, leading to potential future equity dilution if their current cash reserves dwindle faster than expected. If their upcoming second quarter earnings report reveals a slowdown in contract conversion, the stock could easily retest its previous 52-week lows, completely invalidating the current institutional accumulation narrative. Ultimately, BigBear.ai represents a classic microcap case study where the surface-level price action fails to capture the intricate structural shifts happening underneath the order book. The central insight here is that while casual retail investors continue to treat this stock as a volatile speculative lottery ticket, sophisticated institutional players are evaluating it based on its specialized federal footprint and growing defense backlog. The market expectation demands clean, linear subscription growth similar to a consumer platform, but the reality is a complex, government-dependent business model that requires patience, precise execution, and an absolute tolerance for sharp technical corrections. Navigating an asset like this requires looking past the daily noise of retail trading platforms and maintaining a strict, data-driven approach to position sizing and long-term capital allocation. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.